The major news that's driving markets is the US sovereign debt downgrade from AAA to AA1 reliability of debt. Now that you can see has just been rippling around markets. The dollar's the weakest currency of the session. That just reignites that sell US narrative, selling US dollars, selling US equities, selling US treasuries, and the market's hyper-focused on that narrative. And with debt being downgraded, we've had Fed's Bostic out, and Fed's Bostic out has just been stating the obvious, but it doesn't harm to state the obvious, and saying, downgrade will have implications for cost of capital and could ripple through the economy. So that is going to be weighing on markets' minds, and as a result, that euro-dollar buy bias, that euro-dollar sell bias is now gone. Okay, and if you look at the Dixie, you can see that dollar selling is coming back in, and crucially, we're pushing back down through that support level at that 150. So this is a very important area. Dollar weakness pronounced, and we're seeing upside across the majors, as you'd expect with the US dollar being weaker. The pound is also benefiting from the UK-EU summit, which has agreed an outline of an EU-UK not deal, but a just better relationship between the two countries. That's been lifting the pound. So there's a short-term buy bias in the pound dollar intraday. Any retracements, that's that R1. You expect the pound dollar to be bought. And if you look at equity markets, commodity markets, they're all benefiting from the weaker dollar. So there's a nice gold buy bias, there's a nice silver buy bias. That, for me, silver and gold with the rising debt out of the US is going to be significant. And you can see bond yields moving up higher as well, with that kind of reluctance of markets. We're just reluctantly wanting to buy US treasuries with that downgrade. Okay, they're less attractive. And you can see VIX gapping higher and US equity markets also being sold on that narrative. Now, if you just take a look, what's the significance of this? There's a long-standing concern by the market that US debt is becoming unmanageable. So you look here, US debt is currently at $36 trillion. And you see how it's just been rising and rising and rising. And debt's fine, okay, as long as you can pay it off and as long as the market is convinced you can pay it off. And what the growing concern is that the US debt pile is becoming too great. And if you look at the government budget deficit, that budget deficit is at 6.15% of its GDP, right? The maximum has been recently of 14.7% of GDP during COVID. So the US government is spending more than it can afford to pay back. And it's adding to its debt pile. It's not reducing it, it's increasing it. And the current, debt to GDP ratio is 6.15%. That's not sustainable, okay? And you can see here the debt to GDP ratio is 124%. In other words, the US owes more than its entire annual economic output. Right, that's a traditional red flag associated with over-leveraged economies. And as debt rises and interest rates stay elevated, which they are, that means the cost of servicing the debt increases. So at the moment, the 2024 cost of paying for the debt is over $1 trillion. So this means that the US has a very high debt load. And what Moody's have said, they've downgraded the US from AAA to AA1, and it's the first downgrade for 100 years. Right, so that gives you significance. And as I know, as we've been talking about this quite some time, there's this big, broader geopolitical question: is the US is shrinking back in terms of its ascendancy in global trade? And from a geopolitical standpoint, the US is pulling a little bit out of Europe. It wants to focus on China. There's the trade tariff war with China, which is rising up quickly, even as the Eurozone just sort of shrinks back. China's on the ascendancy. The US is sort of flatlining with some worrying concerns around the edges. And all of that sort of picture is adding to that sell US dollar narrative. We have US President Trump, who's taking certainly quite a different approach for US presidents and a different approach for US and the world. And part of that, right, is necessary because the US is financially not quite in the same position as it has been. Now, because the US dollar is the reserve currency of the world, you still got that. It's not that the US has gone bankrupt, or I think it's going to go terribly wrong just like that necessarily at all. Okay, this an underlying concerning narrative, and once again, it's rearing its head. The sentiment here is going to be important. So at the moment, what we're seeing is sell the US dollar, just reminding us of that big narrative. And you see the dollar's down. You can see that US 10-year yields are up, right? Investors are not wanting to buy bonds, and that's for a bad reason. And you see volatility up, US equity futures sort of down for the session. So that's the kind of sentiment that's there.